Today, we will talk about the EBITDA-to-Interest coverage ratio. The EBITDA-to-Interest coverage ratio is a financial ratio used to assess a company's financial durability by examining whether it is profitable enough to pay off its interest expenses using its pre-tax income. It looks at the proportion of earnings before interest, taxes, depreciation, and amortization that can be used for this purpose. This ratio is also known as EBITDA coverage and differs from the interest coverage ratio by using EBITDA instead of EBIT. The EBITDA-to-interest coverage ratio was first widely used by leveraged buyout bankers to determine whether a restructured company could service its short-term debt obligations. A ratio greater than 1 indicates that the company has more than enough interest coverage to pay off its interest expenses. However, the ratio's applications are limited by the relevance of using EBITDA as a proxy for various financial figures. For example, a ratio greater than may first not mean that a company can cover its interest payments if it must spend a large portion of its profits on replacing old equipment, as EBITDA does not account for depreciation-related expenses. There are two formulas used for the EBITDA-to-interest coverage ratio. Analysts may differ on which one they use depending on the company being analyzed. As an example, if a company reports sales revenue of $1 million, salary expenses of $250,000, utilities of $20,000, lease payments of $100,000, depreciation of $50,000, and interest expenses of $120,000, to calculate the EBITDA-to-interest coverage ratio, an analyst first calculates the EBITDA by taking the company's EBIT and adding back the depreciation and amortization amounts. Using the formula for the EBITDA-to-interest coverage ratio, the company's EBITDA-to-interest coverage ratio is calculated. Here are 3 key takeaways. 1. The EBITDA-to-interest coverage ratio, or EBITDA coverage, is used to see how easily a firm can pay the interest on its outstanding debt. 2. The formula divides earnings before interest, taxes, depreciation, and amortization by total interest payments, making it more inclusive than the standard interest coverage ratio. 3. A higher coverage ratio is better, although the ideal ratio may vary by industry. Hope this would help. Thanks for watching.